Welcome back, friends, to the Global Macro Desk, episode 2. Today I'll be discussing two very important topics, not only in terms of global macro, but more so in terms of portfolio management. Topic number 1 is what I call expectation management, and topic number 2 is Delta 1 backtesting and simulations. So let's get started with expectations. So expectation management is good risk management. I'd like to hammer this point home. I will be reiterating it over and over again because it really is one of the most important concepts to understand in terms of managing a portfolio or managing any position in the market. So what do I mean when I say expectation management is good risk management? Well, the thing is, if you can't form correct expectations, there is no hope in terms of managing risk. Let's start with a toy example. Let's say you're investing in some stock. You're expecting it to go up by 15%, and you think the range of outcomes that can possibly happen around that 15% is like 10 to 30, right? 10% to 30%. So a bad year is like 10%, a good year is something like 30%, and you're expecting something like 15. Well, these are your expectations, but the true range of expectations could be something like, let's say, minus 60 and plus 60, and you get hit with a minus 40% return a year later. Well, was this a failure in good risk management, or was it a failure in expectations management? Well, it's expectations, actually. You had misplaced expectations, and then you got hit with Mike Tyson's uppercut, and it knocked you on your ass. There's no amount of risk management techniques that would have saved you. Misplaced expectations or unreasonable expectations lead to a bad place in terms of portfolio outcomes. So risk hits you fast when your expectations don't map correctly to reality. Right. And so we need a mechanism to form good expectations or reasonable expectations. One can argue that any crisis, personal or economic, is simply the result of expectations not being mapped to reality correctly. Once that error is recognized, that's when all hell breaks loose. Well, you can make the case for, let's say, 2009. All right, what was the expectation going up into 2009? The expectation was that these mortgage-backed securities are AAA rated, safe as a U.S. government treasury bond. House prices can never go down. These were the expectations, but the reality was something quite different, that mortgage-backed securities are not as safe as a U.S. Treasury bond, or house prices don't necessarily have to keep going up. Once that error was recognized, that was the 2009 crisis. Same thing that can be said about the tech bubble, the Asian financial crisis, the Japanese bubble, the South Sea bubble, the Mississippi bubble. Pick any one of these episodes, and you can basically, like, the root cause of those problems are misplaced expectations. Actually, these are not just retail guys or people with pure ignorance that fall victim to misplaced expectations. A good example is long-term capital management. Those guys were economic geniuses, winners of the economic Nobel Prize. And what happened to them? They had misplaced expectations about their model, and they nearly blew up the financial economy. Well, so our task then is to form reasonable expectations. Let's see how we can get to that. So for me, I define risk as the unexpected. So if I can form reasonable expectations, I am minimizing risk. Yes. If you can get your mind around this concept, risk management takes care of itself. Anchoring expectations to reality automatically enforces good risk management. If you have reasonable expectations, you are not going to be taking undue risk, right? Like, if you understand that the security that you're trading in can have a minus 50% year, you're not going to take leverage against your position. You're not going to size too heavily into it because you understand that bad things can happen, and you don't have a crystal ball. So, as soon as you have reasonable expectations, risk management takes care of itself. Anchoring implies having a well-functioning map to reality. This goes back to our to the idea of mental models from our last discussion. So maps to reality and expectations they're the bread and butter of portfolio management. If you can't do that, you're going to have a bad time. So our task then is to, how do I gauge reality, and how do I anchor my expectations to it? This is what we're going to be discussing going forward, and we'll build out a simple quantitative model to illustrate my point. So I would like to forget the capital asset pricing model, the arbitrage pricing theory, and every other standard model. I just want to start with a raw time series and see what we can do with it. So let us do away with unrealistic assumptions. Let's make the fewest assumptions as possible to begin with. From my last talk, my base case assumption, the assumption that I make when it comes to financial markets is that human nature is constant, right? It's very difficult to start adding, rationality and efficiency and markets clearing, equilibrium, all these ideas. I don't see them in the markets, and so I prefer not to use those ideas to begin with, right? So let's just start with a time series and let's see what we can do with it. So there's a few ways of forming expectations, reasonable expectations that I use. So the first one is using historical data, and this is what we're going to be focusing on for the bulk of our talk today, using historical data to form reasonable expectations. But the second, more important, in most cases, more important method of forming expectations is via the study of economic history. You have to remember that most of the things that can possibly happen in economic terms have already happened in economic history. So if you have a good grasp of economic history, you can form reasonable ideas of the things that can possibly happen going forward. I make it a point to read economic history going back to the times of the Mesopotamians. It is that important, right? Like if your economic understanding goes back maybe only 20, 30 years, you have no way of parsing, exactly what's happening in terms of, the inflationary pressure the economy is experiencing today. You have no analog to understand what's happening in terms of the world today. Like you don't understand the 1970s, you don't understand the 1940s, you don't understand Weimar or any other analog for your particular time that you're going through. So economic history is very important. If you'd like a list of books, I would love to give a set of book recommendations. And the third method is blue sky thinking. I call it Alice in Wonderland thinking. The quote that exemplifies this idea is, why sometimes I've believed as many as 6 impossible things before breakfast. Earlier, I said that, most of the things that can possibly happen have already happened, but you have to take into account that some of the things that can happen have never happened before. Some things happen for a first time. Thinking outside of the box, thinking about crazy ideas helps in forming, expectations, reasonable expectations. So people tend to put the cart before the horse when it comes to building financial trading models. They jump straight to edge, signal model, alpha signals, and all these fancy terms. But I think it's better to start with the more fundamental question: what do I expect with no signal and no edge? Right? So this, if you start from here, this is the basis of forming realistic baseline expectations for any tradable security. We must constantly practice the virtue of epistemic humility. The path to knowledge begins with accepting our imperfection and our lack of knowledge. So if we can begin here, understand that, we don't know as much as we think we know. We should question how much of what we think we know we actually know. We have to test this by resorting to analysis of quantitative analysis, by resorting to understanding economic history. And just having a sense of humility when it comes to the markets, because the global financial markets is the perfect mechanism to make people to humble people. That's what the markets do. So if you begin with a sense of humility, the chances of you being humbled are greatly reduced. That's good risk management. We need to measure the performance of the market from an assumption of pure ignorance. Only then can we judge how much value our models or our analysis and specialized knowledge contribute to excess returns. Right? Like if you don't know how good your trading strategy is if you don't have something to compare it to. When I say baseline expectations, that's what that's the benchmark that I'm going with. My baseline expectation is a model that has no signal, no edge. It's basically random entry, and then when I compare that to, let's say, an alpha signal or a trading model, I can see that, okay, how much better am I doing or how much worse am I doing? For our purposes, assuming we have no special knowledge, no edge, no special skills, no alpha, is a good place to start. So this is where we'll begin. I've prepared a computational notebook to illustrate an exceedingly simple method I use to form reasonable expectations of forward returns for any given trading horizon and for actually any tradable security. Let's head on over. So I use JetBrains. I'm a JetBrains fanboy. I use all of their products, and I would recommend that you guys do as well. So let's get started. So forming expectations, right? And we're gonna be using historical data. So a question I'd like to answer is, what is an average year for the S&P 500? Average here, I mean average year. If we were to enter randomly, go long the market and hold our position for a year, what is our expected return? And what is our expected return on any trading horizon, any forward-looking horizon? So we begin with 1 year, but you should also be able to answer questions like, all right, what do you expect 54 days from now? Or what do you expect 632 days from now? Like, these are important questions to answer. I try to answer them, and it has helped me quite a bit. So I've coded out this library called the Hyperion Simulation Library. I spent well over a year coding it out, and for me, it's something that helps me. It's a library that helps me manage my portfolio positions. If I were to describe it, it's basically an end-to-end solution for portfolio management in general. Basically, you just stick in, let's say, a trading idea, and it will build out Delta One simulations and map the expectations of your signal onto every option in the associated option chain. You can optimize, which strike and maturity you should be going long or short. You can also use it for Delta One trading, and it also outputs a list of risk metrics associated with managing a portfolio. So we're going to stick in GSPC. I'm using Yahoo Finance here for the data. So the S&P 500 index ticker Yahoo Finance is GSPC. And I'm just going to be calling a method on it. So let's take a look at the price history. So this is the S&P 500 using the log scale. I don't really like the log scale for the S&P 500, but you can see the price history of the S&P 500 using via this plot. And we can see this data basically starts somewhere in 1927. And we can see the Great Depression. We can see all the other crises the world has experienced since 1927. What we're gonna try to do is we're gonna try to build out a histogram of cumulative returns for a 1 year trading horizon. Now, I've used a slightly different method of building out this histogram. It works well enough for our purposes. So if you were to hold S&P 500 with a random entry, like you just enter the market and you want to sort of understand what what you should be expecting 1 year out, or in trading days, let's say 250 trading days. This is the range of returns that you can sort of expect on average. The black vertical line is the mean of this histogram. The mean of this distribution, and it's around 9%. The caveat for using this kind of analysis is that the longer your trading history, the better the estimates you have. So my internal databases have stocks going back to the late 1800s, and I'll get a value that's closer to 8%, somewhere high 7, low 8%. But for our purposes, 9% is good enough. But we can also see that while you may expect a 9% return, on average, the range of outcomes is more like, minus 40 plus 40, actually more than minus 40 plus 40. The minus 40 or minus 50 range is if you were to enter the top of the market and it was an exceedingly unlucky trade. And let's say the plus 40, plus 50 is when you enter the bottom of the market, say like, March 2020 or March 2009. But we can ask the same question for various trading horizons. So what is your expected forward return for a 20-day horizon? What about a 50-day horizon? What about 100, 200? You can do this for any forward-looking horizon. I've chosen 20, 50, 100, 200 just for illustration purposes. And because they're, these are the inputs we use for a simple moving average. The black line is, once again, the 9% that you see for the 250-day trading horizon. So you can see that your cumulative returns are not only become larger the longer your trading horizon, but the spread of those returns also become quite large with the length of your trading horizon. So for various trading horizons, here in our case is 20, 50, 100, 200, 250. Your mean expected return is, for let's say 20 days, is around 0.9%. For 250 days is 9%. For 100 days is 3.7%. So you can basically build this out for any trading horizon. So I've built it out for from 1 day out to 250 days, and you can basically construct what I call a cumulative return path for the S&P 500. So this path looks exceedingly smooth. It's because you're using a very large amount of data, and you're averaging along those data points, and you get a smooth curve. So here you have to understand that every vertical slice is actually a distribution of returns, and the actual line itself is just the mean of those distributions. So for S&P 500, now we can sort of answer questions like, all right, so if I were to trade today, I ran this notebook, I believe on October 17th, using data from October 17th. So let's say if you were to say, all right, what do I expect on May 24th with the cumulative return? Well, it's around 6% with a spread around that 6% of the vertical slice. So using this method, we're now able to quantify what an average year means for the S&P. We're able to extract an expected cumulative return path for a K-day trading horizon. For our case, it's K less than 250 days. But the actual Hyperion simulation library, what it does is it actually builds out a cumulative return path for using the tenor of the option. So if your option expires in, let's say, like 552 days, it'll build out the cumulative return paths going out to 520 days or whatever. But we want to be able to ask another question. So we know what an average year is, but what exactly is a bad year? How about a great year? Can we answer those questions? Doing a little bit of thinking, I did come up with a method to answer those specific questions. And this is what I have. So I can quantify what a beautiful year looks like for the S&P 500. If you were to invest 1 year out, and that would be 54%. But I can also quantify what a disaster year looks like. That's a minus 43%. The average year, once again, is 9%. A good year is like a 20%. A great year is something like a 38%. Now, This disaster year, the way you get a disaster year is if you randomly enter the market at the top of the market, let's say like 2007 or 2000, you entered randomly, you were exceedingly unlucky, and then you got hit with a average 43% drawdown. Right? Same thing with a beautiful year on average is if you were to enter the market randomly and it's the bottom of the market, let's say March 2020 or March 2009, you can, you get something like a 53% return. And same thing goes for every other kind of year. So now we're able to sort of quantify what a good year is, what a terrible year is, what a beautiful year is. So let's say if you were entering the market with the view that the S&P is going to be having a great year. Well, a great year means that, you're sort of expecting something like a 38% return, or let's say it's going to have a terrible year. Well, you're expecting something like a minus 25% return, and that's what we're having at the moment. That's the drawdown what we're going through. It's just a bear market, right? It's not a complete crash. So if you're expecting a bear market, this is the kind of cumulative return you should be expecting 250 days out or one trading year out. I've also built out a table for the cumulative returns for these various for these various kinds of years. So the disaster year, the terrible year, so on and so forth. So you have a range on average that goes from minus 43 to plus 53. When I say that what is your expectation, to have a reasonable expectation, you need to have that number, but you also need to have that spread around that number so you can manage your risk in a more efficient manner. So let's go back to the slides and let's look at a summary of what we've been discussing. So if your global macro fundamental or technical analysis suggests the S&P is going to be having a terrible year, we can now quantify what a terrible year means on average. We can also quantify an expected cumulative return path, which can be used to temper our expectations, manage risk, and more importantly, structure derivative exposure in a very sophisticated manner. We won't be getting into derivatives in this talk, but eventually I will be getting into managing derivative positions and simulating derivative positions for actual trading. That should be soon enough, hopefully soon enough. We can now quantitatively map specific views to a portfolio and more importantly to the real world. And this is what I meant by mapping to the real world. So now we are able to form a baseline expectation. Once again, the baseline expectation begins with assuming that you have no knowledge, you have no trading signal, you have no edge. If you have none of these things, what should you expect? And so now we have a baseline. More fundamentally, we're now able to form a reasonable expectations of forward returns using historical data. So once again, this is using historical data. We're able to quantify the different market regimes we may face and adequately position for them. Right. So if you think we're in for a good year or terrible year, we have numbers that we can attach to those qualitative ideas. Once again, good expectation management is good risk management. Good risk like if you can form reasonable expectations, the risk management will take care of itself. So this same framework can be used to backtest alpha signal models to form expectations for any given trading signal and to quantify the strength and veracity of that signal versus a benchmark. So our benchmark for our case is the baseline expectation, and we're going to be building out a signal model as well. This is done by comparing your expected returns for your alpha signal versus the expected returns of your baseline signal, the analysis that we've been doing thus far. The difference between the expected returns of your alpha signal versus baseline signal is your expected alpha. So now we have a framework for quantifying our expected alpha. So let's backtest the perfect long signal and compare it to our baseline. So I call the perfect long signal, I call this guy the perfect forecaster. This guy is a genius. He knows the bottom every single time, but he doesn't know what else to do. All he knows is the bottom is here, so he just holds his position for 1 year. Let's see how he performs against a long strategy with no edge. Random entry, no signal, just buy and hold, 1 year horizon, and that's what we've built out just so far. So we're going to choose the troughs of the top 25 drawdowns as our entry signals because this guy is a perfect forecaster. We are going to break down the forward 1 year return profile and compare it to the baseline expectation. So I'll be showing you a drawdown table, but drawdown number 10 is highlighted in blue, and it's the one the world is currently going through. This is a drawdown table of the S&P 500 going back to 1927. You can see the top drawdown is the Great Depression, then 2007 and 2000, 1973. And then number 10 is actually the drawdown the market is experiencing currently, right? So we can so what we need to do now is we need to let's take a look at the cumulative returns of each one of those 25 trades. Now I've used R for this. I love R, but there's some things that R is just not great at. So I use a combination of R and Python to build out my analysis. I love ggplotly, ggplot2. And for dynamic interactive charts, I generally just use Plotly for Python, and for R, you have wonderful packages there as well. For R, I actually use HighCharter. It is an amazing library. I would recommend you guys use it too if you're interested in interactive analysis, interactive charts. So we have the world's best bottom picker. That's the perfect forecaster. And this is the cumulative P&L for each one of his 25 trades. He caught the bottom every single time. But you have to understand that just because you caught the bottom doesn't mean 1 year out you're going to have a great time. You can have an amazing time. Like I think this return is from 1928. So that's the rally that took place after the market crash and the 1929 market crash. And there's a couple others there, but you can see that there's a spread even for the perfect forecaster, and there's some returns like the bottom two here that are more like 4%, 5%, even after catching the bottom perfectly. Right, so we need to be able to quantify even the spread of returns that you can experience even with perfect foresight. Right, because not every market bottom is the same. Some are V-shaped, some are L-shaped, some can take longer than others. So let's get to that. So let's get back to the computational notebook to compare the average performance of the perfect forecaster to our baseline signal. So here we have the perfect forecaster. Right, I've taken the 25 entry signals, the dates of those entry signals. And I'm just going to stick them into this method that I call the signal implied forward return distribution. You just stick in dates, and it'll build out forward return expectations for you. So here we can see that the expected forward returns over 250 days for the perfect forecaster looks a hell of a lot better than for someone who has no signal and is basically has no signal, no edge, and is just randomly entering the market. Over a 1 year horizon, the perfect forecaster is expecting 32% return, but our baseline expectation is 9%. This spread here is your expected alpha. Right, between 32 and 9%. But we can also, since the chart in the slides was showing a range of returns, this is the average of those range of returns. So can we define something that looks like a good year, a disaster year, or a beautiful year for the perfect forecaster? Yes, we can. So we have to take into account that not every recovery is the same. We have to take into account the different kinds of market bottoms we can face. Being the perfect forecaster doesn't necessarily imply that every trade is going to be, it's going to yield a massive payoff. We should always be aware of the expectation and the range around that expectation. So for the perfect forecaster, a beautiful year looks something like 122%, but a disaster year looks like a plus 4%. Now, what's a disaster for a perfect forecaster doesn't come close to a disaster for our baseline signal. Our baseline signal, a disaster for S&P with no signal, no edge, no trading model, is minus 43% on average. But on average for a perfect forecaster, it's a plus 4% year. So he's still a genius. But you have to take into account that a plus 4% can happen, but also something like a great year can happen, which is a 74%, but on average, you're expecting something like a 32%. This is an important concept to understand because now we can quantify certain aspects of our signal versus our baseline model, and we can now form reasonable expectations. So let's get back to the slides to summarize what we've been discussing. We've discussed the importance of expectation management and illustrated a simple method to form reasonable expectations for any tradable security, and that's our baseline expectation. For me, I use my proprietary library. It's taken me quite a long time to code it out, but it gets the job done for me. We've simulated and backtested a Delta 1 strategy. We've looked at its payoff and compared it to our baseline expectation. Once again, I'm hammering it home. Expectation management is good risk management. So this was a short talk. I thank you for listening, and stay tuned for episode 3. If you guys have any ideas for some topics that you would like to discuss, just leave them in the comments, and I'll get to them as soon as I can. Have a great day, guys.